Hello, this is Ed Burke with PlaceForTraders.com for Tuesday, March 24th. Starting off in the June S&P. In my last video, I talked about the pivot level of 771.5 being our guide to the direction of the market. If we're above 771.5, we're looking for a bullish market. Below 771.5, we're looking for a bearish market. I had the first line of resistance at 780.25. The second line of resistance at 795. Now the market, needless to say, was very bullish on Monday. It was up 53.2 points at 817.50. The market opened up early on really strong. Between that first and second line of resistance, we briefly pulled back down to a low of 780.50, which turned out to be the low of the day, right at that first line of resistance. If there was any fault with the pivot numbers, it was really that second line of resistance at 795 serving as any kind of significant resistance point. It really did not. The market broke over 800, and then in the afternoon, like I said, powered up to a high of 821. Early on, the existing home sales came out better than expected at 4.72 million units versus the expectation of 4.43 million units. But the real news of the day, of course, was the Treasury's plan to give incentives to private investor money to come in and purchase up to $1 trillion of illiquid real estate assets. Now, if you remember in the last video, I had drawn a trend line just under the last 2 weeks worth of trading sessions. I showed that Friday's breakdown in price broke that little uptrend, and then I showed that the relative strength index on the daily charts showed a classic sell signal, which actually in the past, although the previous sell signals actually served really well if you had followed along with them. That being said, when you're looking at pivot numbers, overbought or oversold oscillators, moving averages, it's all based off of past data. The difference with the pivot numbers is it's taking past data and it's making a forecast for the future. It's giving you reference points, the pivot points, the lines of resistance and lines of support. So that's why we do use also the pivot numbers. By all accounts, just looking at the chart, it looked like, yeah, maybe we can have a little bit more of a sell-off, but we're going to let market price dictate which way we're going to move. So, having said that, we're looking for Tuesday. I'm looking at a pivot number of 806.5. The first line of resistance at 833. The second line of resistance at 848. For support, I'm looking at the first line of support at 791 and the second line of support at 767. Now the market closed at 817.30, the June S&P. The pivot is still way down at 806.5. So as long as we're staying above 806.5, that's still a bullish market. I know it's basically 11 points off of the close of the day on Monday, but that's still considered a bullish market. A breakdown below 806.5 is considered a bearish market. Now, with regard to this chart, I did something a little different. I put up a weekly chart of the June S&P just to illustrate something. I have here in the blue, this blue moving average coming down here is a weekly 18-period moving average, which is served every time we've had a little bump up in the market, like we did right here and we did right here. It's served as a good line of resistance. Now, right now, that 18-period moving average comes in at 832. Now, we're only 1 day into this week. This, of course, is this week's trading bar. We're only 1 day into the week. We've already gone as high as 821. Now, 832 comes right in line with that first line of resistance. I have the first line of resistance at 833. We have this 18-period weekly moving average at 832. And also the monthly first line of resistance comes in at 832. So that's a point to be watching. If we see another update tomorrow, if we start breaking through this 832 level, we could see a nice rally in the market. Going back all the way to 2007, we see this head and shoulders formation. We see a left shoulder. We see the head. Then we see the right shoulder in the market. I drew this trend line right here. This is going from this low here to this low. Now if you come across, when we broke the first time the market started selling off in 2007 off those highs, the first time we broke over this trend line and over the 18 period moving average right back here, we seen 2 months of an up market. Then going back all the way through 2008, like I said, we touched off this 18 period moving average and then turned down right there. And another time back here. We're right at that 18 period moving average, so we're looking for the market to stay above 806.5 for a bullish market. We're looking closely at that first line of resistance. First line of resistance 833. We got that 18 period moving average at 832, and we got that monthly first line of resistance at 832. If we can break that, like I said, we might see a total reversal in this market as we've seen this big breakout so far this week. That's all I have for this evening. If you haven't gone to my website as of yet, it's placefortraders.com. Thanks a lot for tuning in, and good trading.